Hi, David. Thank you very much for joining this time. How are you?
Thanks. I'm good. And you?
I'm doing very well, thank you. Very, very well. So first, yeah, thank you very much for joining. This conversation today is a little bit different than the interviews and the conversations I have with managers normally. We got introduced by a mutual friend and connection, Ken Gettinger in New York. And he sent me some information about your asset management firm, 𝗨, and said there was an interesting manager that I should have a look at. So when I started to dive a bit into it, and I also came across some research that you did. And I think this is the lead up to the conversation today, because given where the market is today, it's Friday, it's the 11th of April. We've had a month of quite a lot of volatility, and particularly in the last couple of days. So I thought it would be very insightful to have a conversation with you about that research that you made about a month ago, and 1929 to 1933 Tariff Analogy. That can be a scary title as such, and I know that it's in the study of economic history, it might not be the best scenario that we want to see, but definitely it's worth discussing. So thank you very much for taking the time for this conversation today. As I mentioned, you have a asset management firm. You started up on your own a few years back. I know that you also have a career before that with Bluecrest in London, a very esteemed hedge fund firm, and with some excellent returns. I've noticed also in the period you were there, they get not just double digit, but I think 2019 was about 53% and 95 in 2020. So you must have seen quite a bit while working in Bluecrest. Maybe it would be great if you could just introduce yourself and how you got into finance, and we can take it from there.
Sure. Yeah. Thanks, Søren, and thanks for this webinar. So I guess I probably started my career at UBS in Switzerland as a securities lending trader on the fixed income side. So that's basically on the repo side. So the sec lenders, they have all these assets and they lend them out to the street. You have State Street and Bowley Mellons. They do it usually in volume. But at UBS, I was really focused on these specials. And so these specials are, it's all about understanding the supply and demand of that specific bond. And on top of that, then comes the sort of the basis, right? You have the bond future, the bond CDS basis, and the repo rate should adjust accordingly. And so that's really kind of got me into this area. And from UBS, I switched then over to Bluecrest. I really wanted to join the buy side. And Bluecrest, it was quite interesting in 2016 because they returned all the capital from the investors. And as a result of that, it was, I think, only around 90% of the money was from Mike Platt. And that led the company to be much more levered. So they needed to have somebody with a focus and an expertise a little bit on doing the repos and the financing. So I joined Mark Bradford on the treasury side there, and it was initially more about working out efficiencies, so bringing the longs and the shorts together, kind of building up the desk. But I think like Mark understood that like my ambitions were not so much to become a treasurer, but really more to work with the portfolio managers. And so in the end, then I managed 25 billion on the repo side, mostly EGBs and gilts. And then 5 billion on the FX side. So that's basically FX swaps. So that was mostly, a lot of it was emerging market currencies like CNH, Hong Kong dollar, and Turkish lira, but also euro and euro dollar, dollar yen. And And last but not least, I also did some asset swaps. So then basically swapping the dollars into other currencies, taking advantage of the cross-currency basis. So the great thing about all that was I could really work with the best portfolio managers on all the different desks. So I worked a lot with John-Michael Grusson on the relative value side. And there was a lot about bond future, the bond future basis. Because a hedge fund is really trading the basis. So the basis between the derivative and the cash product. So there's the CDS bond basis, the bond future basis, the cross currency basis, bond RV, all these different bases. And that was for me kind of a university to learn about all these different bases and really the details of how these trades work. So at some point, for me, it was became a little bit annoying almost because the funding part, if you look at the bond future trades, it's actually a repo trade. Also, if you look on the FX side of things, we had, for example, $100 million of 𝗨, and back then Erdogan decided, right, to do this low interest rate policy while inflation was very high. So the regulator basically didn't allow the swaps to access Turkish lira to the buy side. And so there were a lot of trades that actually where a lot of the P&L got generated on the funding side. But all that P&L basically that I sort of generated on the funding side went into the PM's books. So, and that was always a little bit frustrating to me. And at the same time, I had this UK equity book. That was my PA basically. And that performed really, really well. But occasionally it was also frustrating because the compliance only allows me to buy and sell a position within 1 month. So I had a 1 month holding period. I could only do 5 transactions per month. So in 2021, then I decided to launch Azora Step Capital, basically my own company, and focus really on this UK equities opportunities, because UK equities trade at such attractive valuations, especially in the mid-cap space. So that's anywhere from 300 million to 1 to 2 billion market cap, where you can really have a very quick turnaround in terms of valuations. And so that's kind of what I focused on. Initially, I just worked on my own portfolio then. And now since last year, then I really wanted to bring external investors on board, either offered via advisory, but also via managed accounts.
Oh, fantastic. Congrats on you. Yeah, that's a journey. I mean, that's separate to running your book, building up the asset management side of it. But congratulations. I think we will come in on another day in the discussion on the equity market, because I think what was interesting here is that you're running a long equity book, but you basically paused it, at least temporarily, when you start to look at some of the warning signs of the markets, and probably rightly so, given where we are on equities now. So can you tell me a bit about your way into the economic history? Where did you start, or when did you start looking at these warning signs? Because it's been discussed over many years. Are we heading towards a Great Depression again? Are we is there too much depth? I mean, there's a number of parameters, and some of them you can make similarities to the past, and other times you don't. But tell me, when did you start looking at the warning signs for the current scenario that we are all living in right now?
Yeah, I guess it all kind of started with this volatility event in 2024 in August, because that was very unexpected to me. And after that volatility event, it was kind of, what is the next event? And that was the US elections. And for me, I looked at the two candidates, Harris and Trump, and the policies both candidates had was actually not necessarily market friendly. So you had Harris, who wanted to raise the corporate tax, and Trump, who wanted to do tariffs, 60% on China, 20% universal. So to me, like, even if Trump was elected, which in my opinion was 50-50, I thought this tariff, the potential of tariffs, there's really only one historic point you can look at, and that is this 1929-1933 scenario, right? Because the tariffs of 60% on China would basically, would change the complete way the world currently works. And perhaps, I mean, I got some slides here. Perhaps it's worth if I just put them on. Yeah. So if you go to slide, okay, I got them here. Yeah. So this is kind of, I think, what people should look at. And so you see on the left-hand side, China and the United States, and there's this huge gap where the United States is, it almost appears like the United States is financing China's export model. And so for me, that was kind of a question, okay, with 60% tariffs, that would have a huge impact on the economy. And it's the question whether it works out or not. And so there's always these two sort of heroes that I look for advice. It's one's Warren Buffett, right, who is the fundamentalist. He's the value guy who wants nothing to do with macro, but actually has a very smart macro mind on the back. And two, there's Ray Dalio, who is all about macro. And I think the part I take from Ray Dalio is really, Ray Dalio, everything that happens now has happened in the past. And that's kind of how I got into researching these tariffs. And the largest tariff point of like 60% or anything in that region was basically the Smoot-Hawley Act.
So when I read the report, I saw you had listed, I think, about 13 points that you found that was, or identified, that could be having some similarities. And so how did that kind of build up in your analytic mind? How and how would you expect it to play out in terms of time frame as well?
Yes. So I do a lot of this macro analysis basically as a risk management, right? So I focus on equities long only, look at the value, but the key is always for me that the macro aligns. And so if the macro doesn't align, what can I do, right? And I think in this current point, I really just looked at the Smoot-Hawley Tariff Act, because that was really, it was a point in time where the world had actually a lot of similarities to today. So perhaps I put up that slide. I mean, there's a lot of bullet points here, but what happened back then, what is happening now? So currently, the world leader, which is the US, has over 100% debt to GDP. Similarly to the UK in those days, 1920s, 1930s, with 100 to 200%. Then you had this big rivalry, UK versus US, and now you have it between US and China. And I mean, I'm not going to go through all of the points, but I think the point here being really, there's so many structural similarities between the time period in the 1920s, 30s to the current time period. A lot of people say, oh, this is going to be stagnation. This is the 1970s. But importantly, the 1970s were all about energy shocks. So this is not an energy shock. this is a shock purely based on tariffs. And another structure changes this move towards new technologies. So now we're moving towards EVs, and back then we were moving towards the internal combustion engine. Who was the leader in the internal combustion engine in the 1920s? It was the US. Who is the leader in EVs today? It's China. So there's this basically the existing world power who's suddenly facing a challenge from new world power that is China. And I think this kind of made me look more and more into this analogy. And if I just go to the next slide, how that 1929 crash happened is actually very, very similar to today. If you look just at where interest rates were, how the yield curve behaved. So interest rates were at similar levels as today, around between 4 and 5%. The yield curve was inverted for years. For example, the 10-year 3-month bill was inverted at -1.5%. So that's on the left-hand side. And then on the right-hand side, you see what's happening today. So from that perspective, already very many similarities. And then what happened then in 1929, and a lot of people say this crash was unrelated to tariffs. But if you really go into the details on the day-to-day analysis, you realize that stocks that started to crash from the 21st of October. And that was actually exactly in line with a change in legislation where they changed from lower tariffs to higher tariffs again. Because back then, this 𝗵𝗆 Act, they passed it through Congress, so it had to go through several hurdles, whereas now it's all done via executive orders. But that crash that happened in 1929 was caused by the bill of this 𝗵𝗆 bill on tariffs, where the tariff rates were changed, and that caused the fear, basically, in 1929. And that's why when the tariffs were not announced on Wednesday from Trump, they were much, much higher than anybody expected, and even higher than in his election promises.
Yeah. No, but they also seem to change by the day. So I guess it's difficult to progress the impact if we don't know how far he will take it. At least they're being put on hold, some of them, or adjusted along the way. But tariffs are definitely part of the toolkit here. So how do you expect it to? I mean, what are you tracking as indicators now in order for you to navigate in the market? Are you looking for any acceleration, or are you looking for any changes that might cancel out this rather grim scenario, or how do you see it on a daily basis? Because I guess it still have that outlook that is very, very negative as it look right now, as of today, Friday, the 11th.
Yes, exactly. So that's the thing, right? You don't know if Trump suddenly comes out tomorrow and says, "Oh, no tariffs at all." But I would say this: the one problem the U.S. faces is if they don't go for tariffs, they need to go for either VAT or for income taxes. And I think they just passed basically that the income tax reduction will stay in place. They passed that big beautiful bill. So if they go now, if they backpedal and say, okay, no tariffs, I think there will be a big problem with the revenue for the US government. So that is one issue. And the way I look at it, because I am not like a short seller, I use this analysis more, as a risk sort of hedge, right? So to understand. So it's smart sometimes to go in cash during those sort of moments. But then when I look at the slide deck, when I go back to the slides, I try to understand, okay, what happened back then and what is happening now. And I think there is a big diversion, what happened back then and what's happening now, because in 1929, the Fed actually cut interest rates aggressively. So from 6% down to 4.5%, so 1.5%. But today, the Fed is really on a wait and see mode, right? So and the reason for that is the University of Michigan inflation expectations, which are rising. And so I think the people, the surveys, they're all thinking because of the tariffs, there will be higher inflation. However, I think what history shows us is that tariffs don't cause inflation, because the economic downturn of tariffs will be much, much, much larger than the impact on inflation from tariffs. And I think one good example is, when you have 100% tariffs from China, that product won't be sourced from China anymore. So they will source it from the surrounding countries. And those tariffs will also won't be like zero, but they won't be as bad as like 125%. So I think this is kind of what I'm looking at. And if I perhaps just go on the next slide, and I think this slide is very interesting, because what happened in the 1930s, it was a terrible performance for the stock market, but there were these periods where you actually had for 3 to 6 months, where you really had a strong performance. And so the way I view this currently with the tariff scenario at the moment is, we will have sharp corrections, and those corrections usually last 1 month. But when the market is down, say 50%, there's very attractive re-entry points. And even though the macro is sort of negative, you can re-enter the market basically for a short period of time to make still very, very attractive returns. And certain industry, if you look, for example, at the UK, there are certain industries that could perhaps even benefit from tariffs, because maybe in the UK inflation will go down as a result of it if they open up to China. So there's all these sort of moving parts. And then perhaps one thing to mention on this whole comparison is, the one thing that kind of surprised me is that the long end yields went up in the US. And this is not something that happened in 1929. It didn't happen in 1930, but it did happen in 1931. And I think so back then, the world was on a gold standard, right? And it was in 1931 when there was a first run on a currency, and back then it was sterling. So that was the UK, right? So in 1931, the UK was the world leader. And it feels a little bit that is kind of happening now already to the US. The dollar should usually strengthen in a market downturn. 10-year treasury yields should go down, and exactly the opposite happens. So we might not face this the same sort of up and down like it happened in 1929 to 30s, but we might already be in a scenario like 1931, so a little bit down on the curve, where there is some problems, some structural problems, where we could expect more volatile moves on the FX and yields.
Interesting. Yeah, I mean, definitely it's all eyes to the downside, right? I mean, as you mentioned, normally in a scenario like this, the dollar would strengthen, so would maybe the yen, Swiss franc, and now in the last couple of days, at least, we have seen a significant weakening of the dollar. I'm not sure whether it's purposely driven. I saw an interview about a week ago with Scott Bessent, and still mentioning a strong dollar policy, but it would be normal that there is some fluctuation around. That gives you kind of an invitation to expect some weakening of the dollar. Obviously, as you mentioned, there's the long the rates, the long daily rates. and you can say the weapon that China might have with U.S. the holding of the U.S. treasuries. So I think there's still a lot of weapons that can be used. There's still some, and you would also see, will they be used, and what will be the consequences and the retaliations of that. So we're definitely in for some volatile markets still. Are there anything that you're particularly looking at? I mean, you mentioned in your report about divergence of the long and the short end. How do you see that right now, or is that even an important track?
Yeah, I mean, I would say perhaps if I put on one more slide on quickly on the one, the next one. So one thing I would say is this proves very deflationary, right? So high unemployment, low inflation rate, negative 10%. And so to me, it was somewhat surprising that, for example, UK, the long end sells off. Because in UK, I would actually expect deflation as a result, right? So I think the long end, if you have a strong stomach, you can. It could even be attractive to enter here, right? Because eventually, if this scenario comes in, you have deflation, high unemployment rate. Back then the Fed didn't have an unemployment mandate, and they also didn't have until 1932, I believe, they didn't have a QE mandate. So I think the long end can become actually quite interesting. And yeah, I think on the equity side, I really focus on these turnarounds and special situations. So there needs to be something specific, perhaps in the insurance sector. But then again, I would focus on UK insurance sector could be interesting.
Okay.
Anything that's and ironically, sometimes I look at some companies that are most affected by deglobalization. But those companies are so attractively valued now that, if they issue a trading update, you might get actually a really high, strong return with those companies because the world really is changing, but it hasn't changed today as of yet that much.
Okay. So given that you normally run an equity portfolio and that you at present time are uncomfortable with the macro scenario, where do you park your capital in between? Because you mentioned Berkshire Hathaway earlier. It's been tracked for the last 6 months, how much capital he has or how much selling he has been doing of his portfolio to have a cash holding. I don't know if he's putting it in gold or I don't recall that he's particularly interested in gold as far as I remember. But
Yeah.
But how do you see it? Where do you park your capital if you're worried about the immediate future for equities?
Yeah, I guess Warren Buffett did it quite well, right? He did it. I think he has over 50% in cash now. It's a very smart strategy. Perhaps something else. I mean, the thing is with gold is if China sells their treasuries, and if they put it back into the domestic market, it would lead to an appreciation of the yuan, right? And so that didn't happen. But perhaps what they do is they put the money into gold. But then the thing is with gold is it's already rallied like 50% over a year.
Yeah.
The macro story is intact, but like I prefer rather scenarios where something is very, very cheaply priced, and then that also has this macro benefit. So I think staying in cash for the short moment is okay, because usually these sell-offs, they last a month, and then in a month have a look back. The one thing I would say on US equities is that I think the price earnings is still in the 35 range or so, 30 range or so. So the price earnings ratio of the US is higher than higher than it's been in most times of the past. So that it could take a while to bring that down to 50 or so, where it could get interesting again.
There's a long way down to 15, I would guess, from here. But it's going to be very interesting to follow. And in terms of turnaround or the end of this cycle, is there something that you are particularly keeping an eye on a macro basis?
On a macro basis, yeah, I mean, on a macro basis, I find it a little bit difficult because you see China, they are not reaching out to the US, right? And I think like Trump called them proud, and but I think what's really happening is that China, they see themselves as the world leader and not the US anymore. So there could be some conflicts, right? With Taiwan also, that could happen at some point. I think near term on Saturday you have the meeting with Iran, and Iran. I mean, they've had military exercises with Russia and China, so it's going to be really interesting if Iran doesn't do as the Trump administration said. Israel and the US will attack Iran, and what will Russia and China do in that scenario? So, I mean, the macro basically points towards defense. It points towards gold. But you need to find value in those sectors. I tend to take a shorter view sometimes. So at some points, valuations become so cheap in something where the macro isn't aligned, but where you can then monitor how are the competitors doing. So, for example, if an outsourcing company, or if an outsourcing company is trading at very attractive multiples, and then a competitor presents their results, and the results are quite positive, and there's a strong reaction in the competitor's valuation, then it's the kind of point in time where I would kind of disregard the macro in the short term and just go for the valuation and have that that sort of possible high upside, if that makes sense.
No, it makes perfect sense. Super, very, very interesting, David. I really enjoyed reading your report, and we will also make it available for our viewers, and the slide deck as well, if on 𝗏𝗏, of course. But we will also in the video just share your contact details. So if anybody has any additional questions. Otherwise, I definitely think we should follow up on this, David. You said about a month, so we can come back and see where we are, or if something happens in between, we can do an update. But I really appreciate that you would share your research with us, and I will look forward to follow this. I know we will stay in touch on the market reactions on an ongoing basis. So let's see how this play out, and now we also approach some holidays. I don't know if liquidity normally runs a little bit thin over Easter, so we probably won't have quiet markets anytime soon. But thank you so much for taking the time today, David. It's highly appreciated. Thank you, everybody, for joining in. We will, as I mentioned, share the slide decks and the research that you did. So yeah, have a nice weekend, everybody. It's coming up soon. Let's see how the Friday plays out. But thank you very much for today, David.
Absolutely. Thanks so much, Søren. Very good speaking with you.